Hi, I'm Richard Vague with Tycos. This week, we're going to discuss the federal government's interest payments on its debt. With interest rates at nearly a two-decade high, let's explore what this means for the federal government in terms of increased interest payments, as well as the implications for those receiving these payments. Given high interest rates, you can hardly watch the news without someone lamenting how terrible it is that the government's interest payments are so high, and how it is increasing our already troubling federal deficit. But as we've said repeatedly, the government's interest payments and its deficits in general are not funds that disappear. That money has to go somewhere, and that somewhere is largely U.S. households. Most government spending increases household wealth. Now, let's look to see who holds this debt and who benefits from these interest payments. As we saw in this chart last week, approximately 1/3 of Treasury debt is held by foreign governments and investors, 18% is held by the Federal Reserve, and the remaining half is held by the private sector. So about 1/3 of these interest payments are going overseas, and foreign governments and investors hold so much of our debt simply because of our massive trade deficit. These foreign entities receive more dollars than they spend, and they have to do something with those dollars, and the easiest and safest thing for them to do is simply to buy U.S. Treasury securities. But today, we want to instead focus on the remaining 2/3, or the payments to households, both directly and indirectly through life insurance companies, pensions, mutual funds, and others. These interest payments are critical, influencing investment strategies and financial security for millions, especially when it comes to household retirement assets. Chances are, if you have a pension or 401k, you are benefiting from Treasury interest payments. Even interest payments to the Fed on the Treasury securities it holds are returned to the government, since the Fed sends its net earnings to the Treasury, and therefore these payments also eventually end up benefiting households in the form of greater government spending or reduced taxes, which of course is a rarity. So the biggest part of government interest payments in aggregate go to households. Let's step back for a moment. If foreign governments and investors did not hold any U.S. Treasuries, then the government's interest payments would simply be a redistribution mechanism within the United States. The government would pay out interest on its debt, but U.S. households would receive essentially all of that, directly or indirectly. There's one fly in the ointment, however. Unfortunately, these interest payments are not distributed equally among these households. We estimate that of the $472 billion of interest payments that impacted households in 2023, 71%, or $335 billion, went to the top 10%. So when interest rates are high, it has the effect of accelerating the increase in inequality. That's compounded by the fact that the less well-off have proportionately higher private debt, and with higher interest rates, will be adversely impacted more there as well. That's a long-winded way of saying that high rates benefit the wealthy and hurt the middle and lower income groups. I'm guessing at least some folks listening to this video have never thought of any of this in this way. There it is, obvious and easy to track in the data provided by the Fed and the BEA. Getting back to foreign entities, they do hold 1/3 of our government debt, and after factoring in interest rates, they receive approximately 20 to 30% of its interest payments. We don't want to sound like a broken record on this issue, but as we covered in greater detail last week, this is what bothers us the most about government interest payments. The best way to address this trade deficit is not through tariffs, even though those can sometimes be a useful tool. Instead, it is to increase our spending on world-class R&D to create world-leading products in areas like chips, biotech, and elsewhere. A trade deficit simply means we are buying more stuff from the rest of the world than they are buying from us, an imbalance that can be solved if we make absolutely world-leading products in the most advanced industries. So with that perspective, let's now look at the U.S. government's interest payments as a percent of GDP since 1945. As of December 2023, these payments have almost reached $1 trillion, or 3.46% of GDP. Well, this might seem high. It's still below the peak levels of nearly 5% observed between 1984 and 1991. If we were to take these interest payments as a percent of total current expenditures, we see a similar trend, peaking at 22% in the late 1980s and early 1990s. However, the rapid increase in the last 2 years is noteworthy, driven by both an increase in federal debt and the rising interest rates set by the Fed. Speaking of interest rates, the Fed funds rate is currently 5.3%, the highest since late 2007. A sustained high level influences the Treasury's interest payments as debt rolls over. If we take a look at the effective interest rate the government pays on its total debt, we can see that as older bonds with lower interest rates mature and new debt is issued at higher rates, the government's cost of borrowing continues to climb. So, rising interest rates have a dual impact, increasing the federal government's borrowing costs and enhancing the income for those holding Treasury securities. Understanding these trends is crucial as they affect not just national financing, but also global investing patterns and personal financial planning. That's it for this week. Thanks.